Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today I want to give you a high-level overview of fundamental analysis, what it is, why do people do it, and how it can make you a more informed investor. Now, I'll tell you this up front. Fundamental analysis is one of the biggest parts of investing, or at least the biggest styles of investing, and it is a strong rival to what we call technical analysis. Now, we're not going to cover technical analysis today, but if you want me to, you can just tell me in the comments below. Technical analysis basically takes a chart, it looks at formations, it looks at shapes and says, hey, I'm going to draw a line here. This is going to tell me when to buy and when to sell. Technical analysis doesn't really matter what the company is. The chart tells you what to do. It can be Home Depot, it can be AMC, doesn't matter. The chart tells all, is what technical analysis believe. And then fundamental analysis says, no, I need to know your revenue. I need to know what company this is. I need to know what the rest of the economy is doing. And that is going to help me to make my investing decision. Now, for me, I started off in the fundamental camp. I made some wanderings into the technical camp and then found myself right in the middle. And essentially what I like to do, or say rather, is I let the fundamentals tell me what to buy until I use the technicals to tell me when to buy. So when you see me do my dollar cost average on public, you will notice that there are some days, or some Fridays rather, where I'm not buying all that much, and then others where I'm buying everything I possibly can, and that is due to my own personal, marriage between both fundamental and technical analysis for me. But today, let's focus on the fundamentals. There are 3 layers that you need to tackle when it comes to fundamental analysis. The first one is the economics, what I call context sometimes, in terms of what the economy is doing and how is it supposed to impact investors, or not investors, but the company specifically. For example, the economic context right now, we might be in a recession, interest rates are going up, and inflation is here. These are things that are going to matter depending on what companies you are looking at. So that's number 1. The second one is, how are other companies doing in this category or in this industry? One thing that I brought up when I talked about Target, I said, look, Target is not doing well. They dropped 90% in their revenue or net income or whatever it was at that point in time. Walmart didn't. Costco didn't. BJ didn't. And I didn't just say, Target, this is an issue for you. I said, well, compared to everybody in your industry, this is an issue for you, which made me look at Target a bit differently because I had that context. I looked at that industry. So it's something that you want to make sure you pay attention to as well. Then the last thing that you want to pay attention to is the company itself. So you're starting off the economics of the entire situation, then you're looking at the industry, and then you're zooming in for that particular company. Okay, that is how you want to start your fundamental analysis. Now, next thing you want to do is look at the actual fundamentals of the company. That is, how much money are you making? How much debt are you in? How are you spending that money? And the way to do this is to analyze these 3 statements. I'm going to take you through that today. So that is your balance sheet, that is your income statement, and that's going to be your cash flow statement. So we'll go to I guess it's not a whiteboard in this case, but this is a financial statement for AMC, but I'm going to show you how I got this to begin with. You can always go to Investor Relations, one of my favorite pages to go to on any stock's website. But you can just type in company, Investor Relations, and this is going to come up. And you're going to get a bunch of different documents that they put out all the time. Now, these are the 2 that I like to focus on. The 10Q we've talked about. I think the 10Q and the 10K I've talked about. I also did a video, an article rather, on some of these statements as well. I'll put that, perhaps the link or at least a screenshot here on the page while we talk about it. But in the case, in this case, I went to 10Q. Now, the 10Q comes out 4 times a year, or at least, 3 times a year, because you get the annual one. So depending on what year or what time of the year you're looking at it, you can make sure that you're getting the most recent information. So in this case, we're looking at today. I'm recording this on the 30th of August, but the last statement they put out was on the 4th, so relatively recent. When you click that, you will be brought here, and follow me to page 3. This right here is their income statement, or what they call statement of operations. They operate a business. Where did the money go? How much did they bring in? So quickly, I'm not going to go through every single line. Again, I'm trying to fit this in, 10 or 15 minutes. So the first thing is revenue. How much money did you bring in, and where did that revenue come from? So you can see admissions, food and beverage, other theater. Now there are notes usually in these documents that'll tell you what this other is in most of these categories. But we see here that from June of 2022 compared to June of 2021, this is just the last 3 months of this particular quarter, you went from 233 million to 651. That's a big jump. Then we have food and beverage, another big jump, and then this other theater revenue, pretty much double, a little bit more than that. But overall, my total revenue, the money I brought in, went from 440 million to 1.6 billion dollars. Now that in and of itself looks amazing, right? But here's the thing. Number one, I have not finished reading the rest of this statement. Okay, that's the first thing. But also, this is why you want to pay attention to that context. That is something that's really important, because if I'm looking at it, you have to remember, well, in 2020, theaters were primarily shut down. 2021, people were slowly trickling into the theaters. And then in 2022, people are like halfway going. And there aren't that many movies that are out there. So I'll talk a little bit about that more in a few. But, that is significant growth. But if you go from $1 to $2, that's double, and that feels great. Like, oh, you doubled your revenue. It's like, yeah, but I started from just $1. So you definitely want to pay attention to things like that, and that's why you want to kind of take in that context, the competition and the industry and all those types of things. But that is one of the primary things when it comes to the income statement. Next, and again, I'm not going over each one of these, but it does give you their net loss, and you can see that in a few places. You can see that down here. Net loss attributed to AMC. You can see how they've lost money, and you can see that is lessened. It's you lost 343, then it's coming down to 121. So you can see that yes, they are losing money, but at least from quarter to quarter, from year to year, it is slowly starting to come down, and perhaps they will turn a profit soon. We'll see. But that is one thing that you can tell from the income statement. So it's just one of the things. Then you can see the rest or the end of that statement here with the total net loss here, and then you can kind of break out each of these things based on what you're looking for and how you want to interpret that particular number. All right, so as we move forward, you can see this is on page 5, their balance sheet. The balance sheet is going to tell you their assets, their liabilities, and how much is left for shareholders, like how much of this company do you actually own. In this case, you can see they break this out. This is most most balance sheets rather are broken out in current assets, and then you have your long-term assets as well, or just in this case, just your other assets. This is actually pretty simple. It's kind of like your checking, your savings account, money you can get to right now, and then like your investing accounts, your 401k, where if you sell, it's going to take 3 days to settle, then you transfer it to your bank. It takes you 5 days to get access to your cash. That's more of a longer term asset, but it is an asset for me. And this is what we have for AMC. So total assets here is $9.8 billion. I can scroll down here, and you can analyze what these are, these different categories. But I can see my total current liabilities, total long-term liabilities, and when I look at this whole section, we're looking at $12 billion in liability. So I can immediately see I have way more debt than what I have in assets. Now, is this a good thing or a bad thing? Depends on the industry, depends on what others are doing, depends on context. In my imagination, or not really imagination, but in my mind, without looking further into it, which if you are a fundamental analyst, you definitely would look more into it. But in this case, I'm thinking of, well, you may have had to take on a lot more debt to survive 2020, and you're slowly paying down that debt. That's what I would do if I were in that particular situation. And you could also go and look at, you can see here, well, what was their debt level, and this is from December 2021 compared to where they are in June. Is that debt level dropping? Is it dropping to a degree that you feel good about? Also, what about their assets, right? Is that increasing or decreasing? And how much of an effect can that have on the company? These are things that you want to consider. But you can't just say, oh, you have more debt than you have you have more assets. That's automatically bad. It's not automatically that way. It depends on the industry. A lot of tech companies have run into this issue, and they start off like this and then end up doing incredibly well down the line. The other thing that you want to pay attention to is this. When we talk about the economic context, if you have $12 billion in debt, you're paying an interest on some of that, right? And that interest on $12 billion is going to add up. and it is going to show up on that income statement, because that is an expense somewhere on the income statement that's going to cut into your profits. And as rates rise, that's going to become a bigger expense and something you have to pay attention to. So just throwing it out there, this is one reason why a lot of tech companies this particular year in 2022 have done terrible, because they were borrowing so much money to grow aggressively, and now interest rates are rising, and that is cutting into their profits. And it's like, look, I have to cut something. And unfortunately, what they do is cut labor. We saw Snapchat today say they're going to cut 20% of their staff, which is awful, but Snapchat may have been in a situation like this. If you are a fundamental analyst, you could look and say, look, you got a whole lot of debt here, and I see interest rates are going up, maybe I'll sell, right? That is one way that fundamental analyst or someone who follows fundamentals could look at that situation. All right, so, and this is AMC, it's not Snapchat or any of the others, but you do want to analyze each one of those businesses on your own. All right, so that is one, and then you can scroll down here to the cash flow statement. What the cash flow statement tells us is, what did you do with the cash? Where did you spend that money? And you know, how did cash change through the year? You started off with this amount, you ended up with X amount. So if we look here, they started off negative 459. And where did all that cash go? You can see how cash changed through each of these categories, and it just essentially just details not where every single dollar went, because it's not a budget sheet per se, but just gives you, you know, how cash has changed, and I'm not gonna say evolved, but how cash changed throughout the year, and then how much cash will you be starting off with in the next period. And that's it. That is the high level overview of how it works. And it's essentially saying, what is the business doing? What do I expect it to do? And with what can they do it? So when I say with what can they do it, you got $9 billion. So when I say that, let's say Netflix or somebody should acquire Roku or something of that nature, well, maybe it's because on their balance sheet, they've got the cash to do it, right? They have some assets they can sell to do it. I can see that particular companies may have a lot of debt or a little debt, and that's going to help them to do certain things in the market and take advantage of certain things. But that is again, a super high level. Now, if you want a deep dive into each of the statements and try to figure out, like, you know, what are the gems in each of these and how do I break these down, feel free to join the members only, and we just let me know what you want, and we tend to put those out. And again, these are like 15, 20, 30 minute breakdowns depending on the level of depth of the question that you do have. I also did do this video earlier this year on balance sheets and how you can understand the balance sheet part of this particular equation, which is one of the 3 statements that we covered. But again, I wanted to condense this, make sure it was within 15 minutes. I know the kids are in the back, so you may have heard them beginning of the video. But in either case, wanted to do a quick overview, wouldn't really call this a deep dive, but a quick overview on what it is and kind of how it works. Your interpretations are always going to be different than mine or anyone else's, which makes, all of investing unique and different. It's why people get different returns. Warren Buffett is perhaps one of the most famous fundamental investors. In fact, I'll lean this way. You can see there, The Intelligent Investor basically tells you everything you need to know about fundamental analysis. Now, it is not a light book. I'm going to do a list of books. I'll probably put it out in a tweet or something and put it on YouTube. A list of books that I like to learn about money. That one is not on there because, let me just grab it. This thing is thick. It is not reader friendly per se, where it's just like, oh, I understand these terms. You get it. It's a lot of work to get through this particular book. But this is one that you can use because it talks about understanding each of those forms and what to look for when it comes to a fundamental analysis perspective. And, you know, if it got Warren Buffett's name on it, it says, by far the best book on investing ever written. It might be something that you want to consider. But again, it is not at all for the weak. It's a tough book. But in either case, that is one thing that can help you when it comes to fundamental analysis and kind of getting your arms around this particular tactic or technique or investing style, if you will. All right, so that is it for me. I will catch y'all tomorrow. If you want me to do deep dive videos into this and kind of use what I learned from this book and others on how to look at these statements and how to really, you know, get the nitty-gritty details to help you out, feel free to let me know in the comments below. All right, that's it for me. I'll talk to you later. Bye.